Hello everyone, today's video is all about income tax planning, specifically investing in what we call venture capital trusts or VCTs. So what exactly is a VCT? Well, let's take this rather dodgy looking diagram here. This is a individual, believe it or not, and this individual invests in a VCT. So a VCT, venture capital trust, is a listed company. It's listed on the London stock market. So you invest in a company listed in London. Now this company in turn invests in a whole series of other companies, but smaller companies. All of these down here spreads the investment risk. So this video is about tax planning, but obviously you want to try and have your cake and eat it. You want to have tax breaks and low investment risk. Obviously all investments, there is some degree of risks, but what mitigates this is the fact that the VCT invests in a whole load of other companies. Now, these are all smaller companies, maybe asset size 10, 20 million, but they're all small companies. But that in itself is risky. However, as I said, there are many of them which spreads the risk. So you invest in a listed company, which in turn is in the business of investing in smaller unlisted companies. Now, these types of companies down here, some of them are quite well known, famous household names, have started out life or have had a funding round via the VCT route. One of these companies down here, such as Secret Escapes, Zoopla, Love Film, that was another one. Now, of course, for every one of those that then goes on to become a unicorn or listed on the main market or whatever, there's going to be ones that absolutely tank, and it's about, minimizing the risk. Hence, that's why there's a large basket of companies that the VCT will invest in. They're not all going to take off and be the next Love Film or Zoopla. However, that just gives you an example of the types of businesses that seek this VCT funding. Because what happens is there are thousands and thousands of higher rate taxpayers that invest in here, which then puts the money down here. Now, what are these fantastic tax breaks? Well, 30% income tax credit. Now that's a really good tax break. So keeping the maths easy, assuming you put in £10,000, that would knock £3,000 off your income tax bill. So it's called a tax reducer. In other words, it comes off right at the end of your tax calculation. So assuming you are a high earner, a 40% earner, and all of your income is in salary, you're an employee, and everything's done via pay-as-you-earn. And hopefully your pay-as-you-earn code is correct, so everything comes out in the wash, that there's no more extra tax for you to pay at the end of the year. So what if you then said, right, I want to do 10 grand into a VCT? Well, then what would happen is you do a tax return, and at the bottom of the tax return it says, have you done a VCT? You click the box, says yes, and then you'll get a refund of tax from HMRC. Because remember, pay as you earn, you're all square with the tax man, assuming you just had salary and the PAYE code was correct. But if you've done one of these, then you will get a nice check back from HMRC for £3,000, assuming you did £10,000 investment. If you are, say, a director shareholder of your own company and you pay yourself dividends and you do tax returns regularly every year to begin with, well, you do one of these, it'll just reduce the amount of tax that you have to pay. So assuming you've calculated your tax bill as, say, 15 grand and you did one of these, that would come down to 12 grand. So depending on what the profile of your other income is, will depend on how you are getting the refund or the rebate or the relief. But essentially, the mechanism is a straight 30% of the amount that you've invested. Tax-free dividends. So the dividends that you get from being an investor in this VCT, you will get dividends, hopefully every year. Well, typically these pay out every 6 months in many cases. So once or twice a year, you'll get dividends from the VCT to you as the shareholder, and those dividends are tax-free. They don't even have to go on your tax return. It's a bit like when you have dividends in an ISA wrapper, you just don't even declare it on your tax return because it's tax-free. So tax-free dividends, now typically these investments, some of them pay out 5% a year. So in this world that we're living in of low yields on investment, it's not too shabby at all. So it's tax-free, reasonable yields, okay? But then the next one is no CGT at the back end. So when you sell these investments, and hopefully you've made an uplift, no capital gains tax. So let's say you bought 10 grand's worth, and after 5 years it doubles to 20 grand of that £10,000 capital gain. No capital gains tax. Yes, if you didn't have any other gains, it would fall in your personal allowance for capital gains anyway. But as on a much bigger scale, assuming you put in 100 and it doubled to 200, then yes, you're in a CGT situation. But in this case, no CGT. So tax-free uplift at the back end, no tax, no capital gains tax on any gains when you come out. Now, just some of the rules. You have to have these things for 5 years. This was brought in by the government in 1995. Should have said at the top of the video the rationale for this. It was to encourage businesses, encourage individuals to invest in smaller businesses in the UK rather than putting money into the FTSE 100s, to encourage smaller companies to help them expand and grow. And the quid pro quo for investing in these riskier companies was these terrific tax breaks. That's the rationale. So the government brought this in 25 years ago. It's been on the books for all those years, successive governments, Tory, Labour, whatever, still here. And thousands of higher rate taxpayers have used it as a genuine way of mitigating their higher rate tax. But there are some of the rules. 5-year minimum. So if you decide you want to get out of here after 2 years, the government will claw back that upfront income tax relief. So in that example of £10,000 investment, you've had 3 grand off your tax bill, but you decide after 3 years, I want to get out of here, and you sell, the government will come after you for that 3 grand they gave you on day one. So the other one is a maximum investment. Well, the maximum investment is 200 grand. You can't put any more than 200 grand in there. I suppose, for many people who do this, they're not going to get anywhere near 200 grand, but some of the big higher rate taxpayers, some of the big earners, people with big tax bills, will do the max 200 grand. And the beauty of that, by the way, 200 grand would save £60,000 off your tax bill, 30% of 200. So the good thing about VCTs is that you can recycle the tax relief on the same slice of money. So unlike, say, a pension, where you put money into a pension, and yes, you're going to get tax relief on it if it's an individual pension, and you get tax relief if it's a corporate pension. But the point is, you only get tax relief once on the same chunk of money, and it goes off to the pension. Yes, you've had your relief. But think about this. Let's say you did this multiple times. Let's take that 10 grand example. So 10 grand investment, 3 grand off your tax bill, goes away for 5 years. Then 5 years later, you said, I'm going to do another one. You get your money back. Hopefully you've made a few quid, no capital gains tax. And you say, I'm going to just put that first 10 grand back in again. You get another £3,000 relief, £3,000 income tax rebate. So you see what I mean? So every 5 years, you can get the same amount of tax relief again and again and again on the same slice of money, which is terrific. Unlike with a pension where it's a one-time only on that slice. Yes, you can contribute to pensions every year, but it's with a different. It's with other monies from other profits. But with this, you can basically recycle the same money every 5 years and get tax relief on something you've already had tax relief on. And this is what a lot of people do. So they will put in money every year, but then every 5th year they're recycling and getting the tax relief again on the same funds. So VCTs, a great way to get your income tax bill down regardless of the source. Like I said, if you are self-employed, if you're a director shareholder taking dividends, or if you're a high earner with a salary and you've got pay as you earn, doesn't matter. The rules are the same regardless of the source of your income. It's all about getting your bottom line of tax down 30% credit on the amount that you invest. So that's just an overview there on VCTs, venture capital trusts. If you like this video, please do subscribe right about there, and I'll see you soon.